Greetings, Ed Yardeni here. Thank you, folks, for joining me today. I guess it's a good diversion from watching what's going on in the markets. Obviously, another ugly day. Anyways, here in Long Island, we got a sunny day. It's cold. It's winter, but we've had a very mild winter altogether. When you look at the fact that it hasn't snowed, I hope it's been relatively easy for where you are in weather-wise. In terms of the market, it's been rough going really since the beginning of the year. The S&P 500 peaked at a record high back in January 3rd, the first trading day of the new year. The NASDAQ actually peaked in November of last year, so it started to come down earlier than the S&P 500. And of course, that's because technology has been where the valuation downgrading has been, re-rating has been going on the downside. We are in a taper tantrum. I view this as panic attack number 73. As you know, I've been keeping a log of the various panic attacks we've had in this market. This one is a nasty one, that's for sure. And I think to a large extent, it is a re-rating of valuation, particularly higher valuation multiple stocks as a result of the concerns about what the Fed's going to do. I mean, everybody knows that the Fed's going to be raising interest rates. The only question is how much. And then I think really what unnerved the market is on January 5th, when the minutes came out of the December 15th FOMC meeting, is when they said they were going to let their portfolio run off. And that was a new wrinkle on the Fed's hawkishness. But we'll see how the Fed responds to this taper tantrum. It's not likely that the Fed will do what it's done during the previous three taper tantrums. We discussed the previous three being the May 2013 tantrum. Then we had one in early 2016. And then we had another taper tantrum in 2018. Remember, October, November, December, right before Christmas Eve, we actually made our low. And the Fed responded to those taper tantrums in the financial markets, particularly in the equity markets, by backing off, by actually turning around and saying that they weren't going to tighten after all, or they became increasingly dovish as opposed to taking that hawkish stance. This time around, the Fed can't just do a pivot just because the market's having a hissy fit, and that's because inflation actually has been a problem. And so the Fed is going to have to pursue a more hawkish policy, a tighter monetary policy. The markets currently are expecting 4 rate hikes. Well, they're expecting the Fed funds rate to get to 1% by the end of the year. There's a debate about whether they might start out with 50 basis points or 25 basis points. Maybe because of the taper tantrum we're going through right now, they'll decide 25 instead of 50. The 50 would make sense simply because they clearly are behind the inflation curve and need to catch up. I'm in the camp that believes that inflation is going to be peaking at some point here, probably by the middle of the year. But that's a long ways to wait. And meanwhile, the market's going to be dealing with the fact that for the here and now, we have to deal with a Fed that's actually raising interest rates. So on Wednesday, the FOMC minutes, the meeting will be over, the latest one, and they will issue their statement. And then we'll have Powell do his song and dance. And I have to believe that he's going to try to play it fairly moderate. I don't think he's going to want to come across as being overly hawkish in the face of what the stock market's doing. But then again, Powell is a pivoter. He's pivoted to the hawkish side. And it's conceivable that that the Fed officials might actually view what's going on as a positive. I mean, clearly, as painful as this feels to us in the market, the reality is that we are taking a lot of air out of the speculative bubbles that were in the market. Let's face it, there were bubbles in there, the SPACs, the MEM stocks, Kathy Wood's ARC stocks, and the Megacaps got to 33, 34, 35 times forward earnings. Joe and I have been sort of monitoring the situation. And now what we're seeing is that all the air that came out of the other bubbles, we're seeing some of that coming out of the Megacap 8 right now. The market, the S&P 500 is down in a little over 10% right now as we're speaking. And that's not terrible. It's a correction for sure. I don't think it's going to be a bear market. We could have a bear market in the NASDAQ the way things are going. But I see this as creating very good buying opportunities in the technology stocks that are getting hammered here. And then I would continue to overweight, as we've been saying, energy and financials. Why energy? Well, there's a lot of geopolitical risks out there, which have been keeping energy prices going to the upside. We've had another attack on Abu Dhabi, for example, just today. And then there's the Russian-Ukraine situation. And then climate activists have done a very good job of convincing fossil fuel companies that they shouldn't invest very much in fossil fuels. Why financials? Well, interest rates are going up, at least short-term rates have been going up. Long-term rates haven't been going up, so maybe that is holding financials back. But loan demand is starting to make a comeback. We see another year of fantastic M&A activity. It already got started with Microsoft buying a huge gaming company. So all in all, panic attack, not a bear market in the S&P 500, and not a super bubble bursting, which is the topic of my morning briefing today. But let's have a look at some charts, and then I'm sure we're going to have some good discussion in our Q&A. So let me open up the chart package here. And I'll go to the charts, and let me wet my whistle. Okay, let's have a look. So here's the, as of Friday, here's what the S&P was doing and the NASDAQ were doing. The S&P is in red, the NASDAQ is in blue. Certainly doesn't look very good, looks kind of toppy here. But in many ways, you know, the mother of all meltdowns that I've been talking about certainly seem to have happened here in the 2020 and 2021 period. But even in 2021 period, back in February, the ARK funds peaked and started to go down. So we have been taking air out of the bubbles that have been associated with the mother of all melt-ups. And we've done that without any adverse consequences for the economy or the broad indexes. Now we're starting to hit the broad indexes like the NASDAQ and the S&P 500. But I think we can take the air out of some of these mega caps names without it having any dire consequences for the economy. I mean, back when we had the tech bubble in 1999 and 2000, that a lot of technology spending that was going on in anticipation of the Y2K problem just stopped once we went into the new millennium. Also, a lot of dot-coms burned up their cash, and they weren't in the position to buy any more technology. So there was some real economic consequences for the bubble bursting in the tech sector in 1999 and 2000. And then the bubble that we had in the housing market back in 2007, 2008, that burst, that had real economic consequences. I'm not yet seeing what the economic consequences are of taking some air out of the bubbles here that have occurred in the market along the way here. So I kind of view this as kind of a healthy development to take the air out of bubbles, reset some of the valuations, and create opportunities to buy, especially in technology, which I think is a sector that has been the big winner since the pandemic and will continue to be the big winner in a economy where labor shortages are chronic and companies are going to have to continue to spend on technology to increase productivity. Meanwhile, this story was working out. Things work out until they don't work out. But in this case, there still is, I think, something like $3 trillion of liquidity in the system. So for all the concerns about the Fed no longer filling up the punch bowl still has a lot of liquidity in it. And if you just extrapolate this trend at M2, we're about $3 trillion above that. So I still think there's plenty of liquidity to keep the party going, but maybe the party for now needs a bit of a rest, which is what we're seeing. Bubbles bursting become bear markets when they have an economic impact or something happens in the economy to cause a recession. And as you can see here, the leading economic indicators in December were all-time record high. So there's no sign of a recession in leading indicators. Another indicator that came out that's worth watching is the coincident economic indicator. And what we did here, and you can look at it in the morning briefing, is we showed you how long it takes to get from the peak in the cycle through the trough back to where we had been before. And then how long does the expansion being the growth of the economy after it fully recovers, how long does that last? And it turns out that on average, with a bit of variability, obviously, you can see the variability here, on average, the expansion lasts 63 months. So based on that, there's still plenty of room for the economy to continue to grow and for earnings to continue to grow. But for the here and now, the market has swung around from bursting a lot of fairly minor bubbles to bursting this one, which is a more serious bubble in the S&P 500. But altogether, it's 8 stocks. And if they take a dive here, as they have been, again, I don't really see any macroeconomic consequences that sets the stage for a bear market. And I think, if anything, it sets the stage for some buying opportunities in these names. So here we look at the Megacap 8 share of the S&P 500. That's the red line. And you can see that it's been running around 25%. And clearly that's coming down. Will it come down to 20%? It could, maybe doing that right now as we speak. And at the same time, if you look at S&P 500 growth, Megacaps account for almost 50% of that. And that's coming down clearly. So the market is taking some of the air out of the Megacaps. We can definitely see that in the figure 6 here, where the Megacaps were running at very high multiples as a result of the pandemic. This is the pandemic right around here. And they were running around 24, 26. I mean, it's conceivable that we're getting there pretty quickly here. As you can see, that's the forward PE. Forward PE has come down for the Megacaps to 29.8. That's clearly had an impact on growth. Growth is 24.6. So that's come down. And the S&P 500, which I'd been looking at, and I was marveling at how it was holding on to this 2022 level, and thought it might continue to do that because of that the liquidity there. Well, that was wrong. And clearly we're finding that the multiple has some downside here on concerns about what the Fed's going to do. Liquidity is still out there, but it doesn't have to go into the mega caps. I think all this cash has to go somewhere, and maybe some of that continues to go into energy, financials, beat down stocks. I mean, the cheapest stocks around are the mid caps, as I've been pointing out for quite some time. But right now we got a different dynamics going on in the market, where we've got panic attack number 73, full of fear. That isn't really driven so much by the fundamentals as it is just driven by the Fed. So the market, excluding the mega cap, had a multiple of 18.8 on Friday. That's high, but it's not kind of the nosebleed that bubbles are made out of. So we're probably going to take that down some. But again, I'm impressed by the extent to which the market is taking air out of various bubbles, and in some of the valuation multiples in the marketplace without having any dire consequences for the economy or for the broad outlook for the market looking over the rest of the year once we get past this correction in the S&P 500, possibly a bear market in the NASDAQ. Well, as you can see, and as we've been showing you, the mega cap got to $11 trillion in market cap. Well, not too long ago, there were about $1 trillion in market cap. So that's clearly where a lot of money is going. And right now, a lot of money is clearly coming out of that. But while we're seeing a valuation meltdown in some areas, or just an outright bursting of bubbles in some of those areas that started bursting last year, notice that the earnings outlook still looks great. There's no sign of a recession in the earnings outlook. analyst consensus expectations for the S&P 500, 400, and 600. So these are the mid caps, and these are small caps. These are large caps. Still a V-shaped recoveries. Maybe this is starting to kind of normalize into an upward trend that's consistent with what we saw before the pandemic. But you still have V-shaped recoveries in the forward earnings of the mid caps. And what's happened over the past year is the mid cap prices have gone sideways while the earnings have been soaring. And that's what has brought the valuation multiples down. That, to me, makes them quite cheap and attractive. So let's look at the valuations again. This time, instead of growth versus value, let's look at the cap size. And as you can see again, this mega cap 8 has come down. That's having an impact on the S&P 500 PE. And as I said before, this is a big crash in the valuation multiple, but it's not a crash in earnings. It's just that the stock prices have gone sideways while the earnings have soared. Maybe investors figured out something here, which is now this is catching up with. I was looking at it the other way. I was looking at this looks awfully cheap relative to that, but now this is getting a little cheaper, as we all know. Well, I've got some good news for you. Bearishness is so widespread right now that that could be very well setting up for at least a contrary bounce. If you want to sell into it, that's fine. But the way things are going, we could be making a pretty good bottom here in short order. I would point out to you that when you look at the bull-bear ratio of investors' intelligence, it's as you can see in the table, it's dropped down to 1.59 during through January 18th. I got to believe when we get the next reading of this in a couple of days, it's going to be down to 1. Certainly, that's the way it feels, the way the market is trading. So I think the bull-bear ratio is going to be down to 1. Now look at the history of that ratio. When you look at the S&P 500 relative to these green lines, which is when we fell down to 1, green being go. So go when the when that ratio gets down to 1. And as I said, I think we could be there now. This has been an awfully good indicator of opportunities to buy. And I think it's something you might want to keep in mind here as the panic attack attacks the market. Meanwhile, it's not as though we have nothing to worry about. We still have inflation to worry about. That clearly is the big issue. I have a suspicion that Powell is going to want to soften the blow when he gives us the press conference on Wednesday. And so I won't be surprised if he says that inflation has turned out to be more persistent than they expected. But on the other hand, they do think that some of these supply chain issues that have contributed to inflation will still moderate by the second half of the year. No guarantees, but they're looking out for a peak in inflation. I don't know if he'll say that. Maybe it's just my wishful thinking. But see, I've become just as drug addicted to the Fed's hallucinogenic drugs as everybody else is, I guess. But keeping things to the straight and narrow here, you can see that prices paid, prices received in the New York survey, prices paid, prices received in the Philly area. The good news is they've stopped getting worse. It's not terribly good news, I have to admit to you, because it's diffusion indexes. So they're basically asking these companies, are prices going higher, lower, or unchanged from the month before? And if they say they're not going higher, they're just staying put at these high levels, well, that's actually a good thing, right? Because at some point that actually moderates the inflation rate. So I'm taking some solace from these kind of numbers. I'm also looking at the indicators of the supply chain disruptions. And you can see here that it's kind of a mixed story between New York and Philadelphia. So there's not much we can really conclude from there just yet on the supply chain issues. Meanwhile, on the inflation front, as I've said before, home prices continue to be up a lot, 16.1% year over year for existing home prices. This is mind-boggling. Year over year percent change for median is 31.5%. And that clearly can have an impact on rent inflation. So I am optimistic that we're going to see consumer durable goods inflation coming down by the middle of the year, second half of the year. But on the other hand, rent inflation has got, continue to be a persistent problem because of the impact that monetary policy has had on boosting home prices. So I see inflation coming back down to 3% by the end of the year. And then we'll talk about how the Fed deals with that, whether that means that they have to continue to tighten or whether they change the goalpost and raise the inflation target to 3%. That's it for my monologue. Let's go to the questions here. Okay, hi, Ed. Does the narrowing 2 to 10-year Treasury spread indicate an increasing probability of recession? Gotta wet my whistle. The answer is that's something to be concerned about. There's something to watch. I mean, it's fascinating, right, to see that the 2-year is still at 1%, but at the same time, we're saying that the 10-year is not at 2%. It's not at 2.5%. That's what you would expect in normal times, but we're still very much in abnormal times, and so the bond yield is 1.7%, which is really pretty impressive. And it looks like the taper tantrum in the stock market is certainly putting some downside on the bond yield. But it's a good question. The 2 to 10-year has flattened out, and that is an indicator that the bond market perceives that if and when the Fed starts really tightening, they may not have to tighten very much before something goes wrong in the credit markets, causing a credit crunch and then causing a recession. It's also possible that the geopolitical concerns are having an impact on the bond market. I mean, this is a risk-off trade, and risk-off typically means U.S. bonds. And so concerns that Russia will invade the Ukraine might raise the possibility that oil prices spike, and we've had recessions caused by rising oil prices. So we do want to watch that. It's usually an inverted yield curve that signals a recession, and it's interesting that I am seeing more people worrying about a recession, talking about it. Well, there's nothing like a sell-off in the market to start people wondering whether the market sees something that the rest of us haven't quite caught up to. To what extent do you see growth concerns in current markets, and is an economic downturn a possibility in the face of Fed tightening? Okay, a very similar kind of question. Let me make a couple of points here. One is the consumer is slowing. Omicron is certainly having an impact on services. People are calling in sick. So that may also be causing another round of supply side disruptions, then inflationary consequences. We live in interesting times, that's for sure. So a slowdown in consumer spending would be worrisome. But on the other hand, it would probably give businesses an opportunity to rebuild inventories. So I think inventory rebuilding would offset some of the weakness from the consumer side. By the way, if the consumers are starting to resist price increases and say no mas, there's stories about them going out to the Costco's of the world and just buying stuff in bulk. And if maybe they start cutting back on some of the spending sprees they've been on, that could moderate price inflation too. And again, create an opportunity for retailers and for manufacturers to restockpile inventories. Keep in mind also at some point here, the auto industry is going to be getting the parts that they need, the semiconductor chips that they need to finish the cars. And there's still plenty of pent up demand for cars. And when that happens, that too could moderate used car prices and new car prices, which have been a big problem. A big part of my story is capital spending continues to remain very strong, because what's really different this time is that there's a real shortage of labor, and companies have to use technology. They have to invest in capital equipment to increase productivity. And so I think capital spending remains strong. So I'm not in the recession camp. We're using 2.5% growth for the first half of the year, 3% for the second half of the year. And bear in mind, that's probably going to be all productivity because labor force growth just is chronically weak here for demographic reasons. Are you still favoring U.S. equities over Europe and emerging markets? That's a good question, because that's a question I've been discussing with my partner, Joe. We clearly have seen that because of the underperformance of the decline in the mega caps, which have been a big contributor to the outperformance of the US, that suddenly foreign stocks are looking more attractive. The short answer is not yet. No, we're still sticking with overweight the US. Oh, I guess one of my puppies decided to join us here, as you may have seen in the background. But the stay home never was a recommendation to just stay in the United States. It's overweight the US. And I think there's some pretty good opportunities being created here by these sell-offs. Let me turn that off. Thought I had turned that off. Okay, let's see what else we got. Powell also considers his legacy Art Cashin. That said, will Fed happen? Historically, Fed gave into the market pressure. Well, as I said before, I think this taper tantrum is different from the previous three. I don't think the Fed can really back off this time. And I think that's because in this situation, there really is an inflation problem. In the previous three taper tantrums, there was no inflation problem, and there was no real significant consequences for the Fed to kind of back off and react to the markets. And as I said, there is a happy story to be told here. It's a good thing that if we did in fact have the mother of all melt-ups, some people call it the bubble and everything, occur in 2020, 2021, if we're taking the air out of those bubbles without any significant economic consequences, without the kind of turmoil that creates a bear market and economic problems, then that's a good thing. So no, I don't think Powell's going to be able to relent here. But we're all going to be microanalyzing every single word in his press conference, and I'm sure he's going to be probably reading a lot just to stay on script. Let's see what else we got. What do you consider to be technology? Since the index providers have recently decided to spread technology companies throughout the various sectors to maximize ETF sales. A good point. It's a question mark, but it's a good point. The magic 8 ball are in tech, consumer discretionary communications. Yeah, I mean, we've been, Joe and I have been making that point for a while on a regular basis, that the Megacap 8 aren't all technology stocks. 3 are technology stocks. 2 are consumer discretionary, and 2 are communication services. So I like that implication that the reason that was done was to sell ETFs. But I don't think the implications of anything I've said really change. I mean, the mega cap are still 50% of growth, and they're still 25%, or before this recent sell-off, were 25% of the S&P 500. Okay, Doug, what do you consider to be technology? Since the index providers, I'm sorry, I'm reading Doug's question again. Why is Grantham so bearish? What is the bubble he sees that we don't? Well, we might be you and me. There's lots of other people who have other opinions, and maybe Grantham's timing has been impeccable here and got a lot of people scared that this really is the beginning of a bursting of a super bubble. He thinks there's bubbles in everything, in the stock market, in the bond market, in commodities, and in housing. Housing, as I said, just showed you, it's up like 30% on a 2-year basis. So it certainly looks like a bubble. But then again, while there have been some speculators in the market, or institutional investors just trying to get an asset that collects rent, there's been a tremendous amount of fundamental demand, and the underlying supply hasn't been sufficient. So I think there's a real fundamental drive here behind the high prices. And I certainly, I mean, look, if the price of housing suddenly dropped 10, 20%, I don't think it would have anywhere near the consequences we had during the last housing bubble. I don't think people would be walking away from their homes, or mortgages would be blowing up, or derivative products would be blowing up. Commodities have been going up because of the post-pandemic increase in global demand. So I don't see that necessarily as being a bubble. I'll give him that the bond market at 1.7% with inflation at 7% certainly looks like a bubble. But the reality is we just keep sticking at this below 2% level. Maybe that'll suddenly change when the Fed actually starts to draw down its balance sheet. But for now, the bond market is where it is. And there are other bond markets that have also been in bubble territory for a long, long time, like Japan and Germany's bond markets. And yet they're still there, notwithstanding the fact that it's not as though those countries have been growing. David, okay, that was David's question. And then one more, can you remind us when you started counting the panic attacks? You referenced this one as number 73, for instance. Yeah, I mean, we started counting them in 2009, and there's a table on the website. We'll post it again. There's a link in the morning briefing to it. So we did this all in half an hour. I think we covered the issues that are relevant to these wild markets that we're in right now. I wish you a great week, and I wish us all a kind of a capitulation, a sell-off here, which certainly feels like we're getting close to very, very quickly. So again, thanks very much for tuning in. Let's do this again next week.